Delivering his semi-annual testimony on Capitol Hill yesterday, the Fed chairman said that decisions on interest rates would be made as needed. At the same time, Jerome Powell rejected the idea that the regulator would act to please the ruling party ahead of the autumn presidential elections. However, the unexpected decline in the 3-month average number of new jobs in the U.S. labor market looks like a serious signal that the American economy is losing momentum. At this stage, reports on inflation rates matter a lot to the Fed's decision-making. Consumer inflation data is due in the U.S. today. According to forecasts, the annual growth rate of consumer prices should slow down from a 3.3 to 3.1% in June. If the CPIs come out at the estimated figures, the US dollar will be able to maintain its current position. But if the indicators record an unexpectedly strong decline, this will deal a serious blow to the US currency. And it's not just about the US central bank's target of 2%. The thing is that the regulator is concerned about squeezing the US economy with extremely high interest rates. So, the US Fed is striving toward a slowdown in economic growth. That's a recession, which leads to deflation. That's a sharp drop in prices due to lack of demand. And this is an unwelcome scenario, especially before the US presidential elections. Thus, speaking on Capitol Hill, Jerome Powell made a few soft hints regarding monetary policy that has fueled market hopes for a rate cut later this year. Today, in anticipation of the crucial economic data, the US dollar has weakened. Its index is trading within the intraday corridor of 104.80 to 105.00. Its fall is so small that the currency market is treading water. Meanwhile, Wall Street continues to test record highs. Investors are anticipating a slowdown in inflation, which would pave the way for a rate cut in the US as early as September. In any case, the S&P 500 index is trading higher today, moving in the range of 5,586 to 5,635 points. To sum up, the main market catalyst is the prospect of lower interest rates in the US. In the meantime, the situation for the Japanese yen is changing for the worse. The dollar-yen pair is permanently affected by the sharp difference in interest rates between the US and Japan. And today the yen is trading near its weakest level in decades, in the area of 161.40 to 161.80. The Bank of Japan is expected to present its recovery plan for the yen at its upcoming meeting on July 30 and 31st. Many private banks are calling on the regulator to slash twice Brent's bond purchases by around 2026. With this approach, as well as a rate cut by the Fed Reserve, the dollar-yen pair will be able to shift slightly down on the trading chart. The euro-dollar today has already received some support from one central bank of Europe. And this, however, is not about the Eurozone regulator, but about the Bank of England. Its spokesman said that the first rate cut may be delayed due to persistent inflation in the domestic economy. With such prospects, the pound sterling was able to strengthen, and the euro followed suit. In the first half of Thursday, the single European currency is following an uptrend within the intraday corridor of 1.0833 to 1.0855, and the dominance of the bulls was confirmed as the euro-dollar pair settled above 1.0800. So we can expect the next bullish move in the future, and this time about the level of 1.0650. In this case, the currency pair may further strengthen to the key round level of 1.0900. An alternative scenario assumes fluctuations in the range of 1.0800 to 1.0850. The soft US dollar also played a role in the growth of oil prices. In addition, judging by data from the US Department of Energy, US oil inventories decreased by 3.4 million barrels last week, and this pushed oil prices up. If we look at the situation a little more broadly, then oil prices were trading in the range from $85 to $86 per barrel and remain in this range today. At the beginning of July, oil charts showed a higher volatility. The Brent price is likely to trade within the same borders until the next report on the US oil reserves. That's until the middle of next week. In the meantime, the corrective cycle of the Brent price was interrupted at the level of 84, where some sellers decided to exit the market. This led to a partial recovery in the value of the asset, and this may signal Brent buyers about a new round of price growth. The bearish scenario will come into play again if the price falls below 84, considering that the US inflation report may trigger high volatility across markets. Oil may also trade on a seesaw. You have watched a roundup of the global financial markets for today, July 11. Keep close tabs on the global markets on the InstaForex TV channel. Feel free to leave your comments. Our experts are always ready to answer all your questions. Thank you for watching and see you online tomorrow.